Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Chris and Marisa DiNatale. Hi, guys. How are you?
Hi, Mark. Doing well. You look somewhere
Chris.
different. Where are you?
Well, guess. Take a guess. Guess just where I am right now.
I guess you're at, my guess would be 7 World Trade Center, New York City.
Exactly. HQ. Moody's HQ. Kind of in a nondescript office space on the 52nd floor. I'm going to speak at the public finance function here in the not too distant future. So I've been spending the last couple of days. Actually, interestingly, I had dinner last night with some clients in Tiffany's. I didn't know you could do this. They have a very nice restaurant
in the jewelry store.
You have to get to the restaurant. You have to walk through the jewelry store. I think that's intentional.
Yeah. Did you buy anything?
Well, it was the first time I've ever been in Tiffany's. Have you been in Tiffany's in New York? Have you ever been?
I don't know that I've ever been in the one in New York. I don't think so.
Yeah, there's a lot to absorb. It's like eye candy. It's pretty.
Yeah.
It's pretty to see. Yeah, but the food was fantastic. So
I thought they only served breakfast.
Good one.
Chris, we have another guest here. One of our colleagues, Chris Lafakis. Hey, Chris, how are you?
I'm doing great. How about yourself?
So, did you hear Chris DeRee's comment there about breakfast at Tiffany's? Are you old enough to know what that's all about?
Yes, I am, Mark.
Yeah, who is the star in that movie?
I don't know the answer to that question.
Oh, geez. That's good for the stats game, I think. Yeah,
I'm a little old, but not that old.
Yeah. Marisa, do you know who the star was?
Hepburn.
Yeah, Audrey Hepburn. I love Audrey Hepburn. She was such a great actress. Yeah. Anyway, so it's been busy week here in New York, but on to business. We have Chris Lafakis on because we're going to talk about hurricanes and climate change and what it all means for the economy. Obviously, we had a pretty devastating storm that went through Jamaica earlier this week, and I haven't been able to watch the coverage, so I don't know what kind of damage it's done, but I'm sure it's been pretty debilitating. But we'll talk about that. But before we get there, and we'll play the stats game as well. Do you guys have a stat? Do each of you have a stat? Good.
Plenty of stats.
Plenty of stats. Okay, very good. Even though the government's not producing any data, you come up with stats.
You can always gin something up, you know?
Doesn't take much.
Exactly. Okay, we'll do that. But before we get to all of that, I thought we'd talk a bit about at least from my eye, the rash of layoff announcements in this past week. It just feels there's always layoff announcements by businesses. We get it from the Challenger Gray and Christmas data. We can see that, but it just feels like it's jumped to a whole nother level here. Amazon, Target, Paramount, I think UPS. Am I missing anybody? I think they all kind of announced layoff announcements. Anybody else? I'm sure there has been.
Yeah, there's a few more. It's escaping me, but big numbers, right? They're all really big numbers.
Yeah. What do you, Marisa? What do you make of it? Let me preface it by saying I'm very schizophrenic about how I feel about the economy. One day I feel pretty good. The next day not so good. I'm having a hard time getting a grip with my emotions around the economy. Usually I've got a very clear, something's going off the rails or the economy's doing just fine. And we got our forecast and I'm okay with it, but I just feel at loose ends a bit. And, I look at the stock market, it's on a tear and I go, oh, things are good. Then I listen to these layoff announcements and I was in a couple Ubers, drive with, running around Manhattan, talking to Uber drivers. And, people are just really uncomfortable. They're nervous. I know it's an anecdote, but so is the layoff announcements. And so is my observations around the equity market. So it's all anecdotal, but I don't know. Do you feel the same way I do, Marisa?
Definitely. Yeah. I feel really uncomfortable about the job market. That is very worrying to me. But like everything else looks okay, kind of, right? I mean, the housing market isn't good. I think we would all agree, which is a big part of the economy.
Can you say, before we move on, that you make a great point there. I think it's all the schizophrenia in my mind is all encapsulated in comparing GDP with jobs.
Yeah.
I look at GDP and I go, it's not great. It's okay. I mean, Q3 GDP, if we had ever got it, would probably be pretty good. But, that's quarter to quarter. Abstracting from that, we're probably growing around 2% GDP, which is okay. It's fine. But then you have no jobs. So that kind of sums it up right there. If I look at the job numbers, I go, oh my gosh. And if I look at GDP, I go, okay, it's okay.
Yeah.
That's what you're saying.
Yeah. And then the stock market is crazy, right? And you have these companies, AI just powering the stock market. It seems very narrow. Nvidia just hit, what was it, $5 trillion, $6 trillion in valuation. Right? First company to ever do that. I mean, so you're always getting news like that. But then on the other hand, you're getting news about Amazon laying off 40,000 people and we don't have job growth. And we have, other surveys that aren't government surveys showing people are anxious about the job market and we're not hiring, but we're not laying off. So it is really difficult to assess your overall state of the economy when I think for most people, most ordinary people, not economists, they don't really care what GDP growth is, right? They care whether or not they have a job. So that's what ordinary people, non-economists are looking at. So I can understand why the mood is so dour.
Yeah, the thing, you look at unemployment, the unemployment rate's 4.3%. You go, oh.
Yeah, or at least it was 2 months ago.
Well, at least it was. But, I mean, that feels like it's on the high side of full employment, what would be considered full employment. Maybe there is a bit of slack. But the thing that I think people are nervous about is, okay, I have a job, but if I lose my job, I'm not going to get another one.
That's right.
There's just no one is hiring out there.
And you can see that in surveys when they ask people how they feel about their prospects in the job market, is people say, I think it's going to be very hard to find a job. And then you have all these layoff announcements happening, which so far has not shown up in the official UI data, unemployment insurance claims data. We'll see tomorrow what this week's UI data look like. When we sum up all the states. We don't have that yet today, but that's not really reflecting this rash of layoff announcements that you see in the press.
Right. Of course, layoff announcements take time to execute on. So
that's right. They're not layoffs yet, right?
Yeah,
they're announcements, and they could change too.
They could change.
And a lot of the layoff announcements I've noticed are companies saying they're just not going to fill open positions. So they may say we're cutting headcount by 20,000, which means we're not going to fill the 10,000 open positions that we have, right? So they're not all people being laid off. Sometimes they're just cutting job openings. Like I believe Meta or UPS, one of those said that. It was a significant chunk of what they said the trimming was going to be. Was not actually outright laying off, but just cutting job openings.
Just factually, you said Amazon announced 40,000?
I think that's right, yeah.
Was that the number? Was it 40? I thought it was more like 10. Anyway, it was a big number.
One of them announced 40,000. Yeah. It may not be Amazon. Because Meta announced, right? So there was Meta, there was Amazon.
Right, okay.
UPS, Rivian.
Right. Okay.
Amazon is 14,000 jobs, right?
Okay. Well, there's 4 in it.
Yeah, there's 4. It's still a lot of jobs. It's still a lot of jobs. Yeah. Chris, are you having the same kind of trouble getting kind of an emotional grip on what's going on here with the economy as I am?
Yeah. I mean, I think the lack of data certainly adds to that.
That's a great point.
The data void, you're trying to fill the void. And so any little piece of, any anecdote, like you said, kind of takes on new importance. So the Uber driver said, everything's going to hell. That becomes about gospel. When I look at these layoffs, though, I also struggle in terms of trying to decide if these are idiosyncratic or to those specific companies or not. Or so several of these companies have been in trouble, or they're not haven't been doing great. Like Target has struggled now for a while. And so having some restructuring going on there, okay, I can kind of see that. And I'm not hearing anything from Walmart, right? So it seems like, okay, well, that might be unique to Target, or UPS. Take that case as well. There, again, is that really reflective of the broader economy, or is it something that's very unique to that specific company? Or Amazon, I can make a case that they hired up aggressively during the pandemic, and now it's just a natural rebalancing of their workforce. So how much of this is really driven by AI or the weakness in the economy versus the natural restructuring that goes on in these companies from time to time? So that's where I struggle in trying to without the broader data to give us the broad trend. I'm left with trying to understand, well, how much of these observations, these anecdotes, are really creating the trend versus kind of one-off situations.
Yeah, you make a great point. I hadn't dawned on me that I feel unmoored, probably because I am.
Yeah,
I don't have any data. And the further you get away from the last data point we got, which is now a month old, the more unmoored you feel, and you start relying on these anecdotes. And now we're no longer like economists, right? We're like, and that's why people are so confused about the economy. I think, because they're not focused on the data like we are, and they don't have a frame or a way of thinking about it, and they become very, very nervous. And that's what's going on here. I just don't have the data.
There's that. I also think Marisa kind of alluded to a great point just again about the bifurcation in the economy, right? I traveled to a conference this week. It was great. The airports were full, lots of activity, but I know that that's not representative of the entire economy, right? You go in other parts, right? Walking through downtown, you can see that, there's some struggling going on there. So it certainly depends on which part of the economy we're talking about, and the aggregate GDP figure that you mentioned earlier, right? That doesn't capture kind of all the moving pieces here. And some industries doing okay, others not so much. Some demographics doing fine, higher end consumers versus lower end consumers, not so much, right? So,
yeah, here's the other thing that worries me, and maybe you can talk me off the ledge here, Marisa. Is AI? AI hasn't ostensibly had a large impact on the labor market, at least so far. It's having an impact. You can see it in tech jobs and programming jobs. There was a good study based on ADP data. Eric Bjorn Folson, I think of Stanford, looked at it at kind of what was going on with jobs by age of the worker. This is demographic data they can get from ADP, and made a pretty clear case that it's having an impact on kind of younger workers more than others, and that's maybe one reason why the hiring rate is so low for people in their early 20s and having a hard time getting a job. But outside of that, it feels like it hasn't had a large impact, but it feels like it's going to have an impact, a much larger impact than it's having right now. And we're already at zero in the job market. I mean, there's literally no job growth, or very little, on the margin. And I suspect after we get revision, it'll show no job growth. And this is before the AI effects really start to take hold here. I mean, so far, all the layoff announcements, all the AI effects are large companies. But, this is going to filter down to mid-sized and smaller companies over time and have an impact. So, and it does, yes, there's going to be some additional demand created by by AI, new products, new services, and the wealth created should create more demand. But it feels like these supply side effects, the job effects, are coming faster and will have more of an impact sooner. We'll get more layoff announcements, and of course, if that happens, then we got a problem. I think we've long been arguing that the firewall between the economy we have right now and a recession is no layoffs. So, forget those layoffs, we got a big problem. Cris, I know you've been thinking about this a lot. Go ahead, talk me off the ledge. Oh, can you
talk him off the 52nd floor? Go ahead.
Exactly.
I'll do my best.
Well, what do you feel? Are you with me?
I feel like I do feel like we're getting ahead of ourselves, right? When I look at the AI projections here, yeah, it's a great technology. I'm using it. I think we're all using it to some degree, but still, it's not a replacement. It's augmenting. I just don't see it in the short term having such a dramatic impact. So again, I guess goes to your earlier point in terms of trying to understand what's going on in the economy. I suspect that many of these layoffs that we're hearing about, or the restructuring, although it's ascribed to AI and the potential for AI, I think it's more basic reconsolidation, uncertainty about the economy, given all the other policies. We're still trying to absorb tariffs and immigration and everything else. I just don't see that AI is the reason suddenly that we are immediately laying off folks and having a very dramatic impact here. I think there will be changes over time, but I don't see it. I don't see that there's this direct connection between, ChatGPT advancing and suddenly we are dramatically recreating or adjusting everything that we're doing in terms of our productive activities here.
So you're saying, don't worry, be happy. I mean,
I don't know that it. Yeah, I think we should be worried about the economy, right? Because there is the weakness in the job market. I just don't. I'm having a hard time connecting the dots directly. That weakness in the economy, the layoffs that we're seeing, or the lack of hiring, is a direct result of this AI boom that's going to really replace all these jobs. I think it's augmenting. I think it's helping along the edges. I don't see that apocalypse, I guess, happen.
Not apocalypse. I'm not talking apocalypse. Or maybe I don't. Maybe I'm talking potential recession. So, but that maybe that's apocalypse. No, I'm just, my thought process has been, look, the job market is weak. There's no doubt about it, right? There's no hiring. Hours are down. Temp jobs are down. The only thing that's kept it together, and by my thinking, the economy together, is no layoffs. But AI's effects to date have been, I agree with you, really on the margin. But are we saying that that's going to continue to be the case here? I mean, it feels like it's coming on pretty fast, and we could see many more layoffs in the next 6-12 months. And if we're still in a world of no hiring, which feels like we're going to be there for a while, that's the fodder for outright job loss. And at that point, that firewall I mentioned comes down, and we're in recession. You just don't see that, or you discount that.
Yeah, I'm discounting that.
You're discounting it. Okay.
Let me throw in. I always come back to this. It's my favorite topic: demographics. Does that enter into your calculus at all? That we do have 13,000 boomers retiring every day. That's going to continue to weigh on the job market going forward. So we actually do need this technological innovation to keep going here. And if anything, right, we're going to scramble for workers, right? Going forward, unless you really think that AI, the productivity gains are dramatic, right? Without immigration, with the retirees continuing, isn't that going to continue? That's going to create some opportunities, I would think, going forward for new workers.
Okay, I think that argues. That's a good point. What's going on with labor supply? And you mentioned the boomers. There's also immigration.
Right.
The fact that foreign-born labor force is declining now with the highly restricted immigration policy. And that would argue for we are going to see much slower job creation. But are you arguing that we're actually going to see potentially, I'm arguing we could see some, job loss, some employment declining. Are you suggesting that labor supply would be consistent with that, the actual job loss? I mean, because for this not to be a problem for the broader economy, what I think you're saying is the labor supply is constrained enough that even with the weak labor demand, even with some negative numbers, that's not enough to push unemployment up, and that's the key to recession. That's the part of the firewall coming down. You get layoffs, and then you get on a higher unemployment, and that spooks consumers, and you get into a kind of a self-reinforcing cycle. And what you seem to be arguing is, okay, you may see negative numbers because of AI, but no big deal. The labor supply is going to be constrained enough that unemployment isn't going to rise to any significant degree. Therefore, the firewall isn't going to come down. Is that kind of sort of what you're saying?
Yeah, basically both the numerator and the denominator.
The numerator and the denominator.
In the
it's a very complex story, isn't it? Yeah.
Well, it's a complex economy, right?
Yeah.
So,
well,
that's going on in the background, right? That's undeniable. Those demographics are happening.
Yeah. No, it's undeniable. Right? Yeah.
The AI story is more suspect. We don't know.
We don't know
what's happening there.
Right. Right. Marisa, you want to weigh in on this? How are you thinking about this?
Yeah.
I mean, you got me kind of on the more worried side and Chris on the more sanguine side. I don't know how big.
Which feels weird, by the way. That just feels weird.
Weird. Yeah.
It's usually the opposite. But.
Yeah. Exactly.
Yeah.
So you want to weigh in on this?
Sure. I mean, I think it's very way too early to start declaring that all these layoffs are because of AI and, we're losing all these entry-level jobs because of AI, or it's creating all these jobs. I mean, certainly it's creating jobs too, and we don't talk a lot about that. So I was looking at data from Indeed, their hiring lab, and they analyzed job postings, right? And they said last month that like 70% of job postings across every industry had some mention of wanting AI skills in any job that was posted. And their caution around that, they did some analysis and they said, there's not a lot of context around what a lot of these postings mean. They don't go into detail about what exactly they want people to do with AI or how they're going to use it or implement it, right? They're just kind of throwing that word around. And I think that could be happening on the job loss side too. I think, like Chris has said in the past, that it could be a cover for companies to say, we're going to lay off a lot of people and, we've just found that we don't need all these positions. We're consolidating because AI can do some of this work. There's no verifiable way to know that that's actually the case. I mean, certainly I think a lot in the tech industry, you can absolutely say a lot of layoffs are coming because of the restructuring of jobs and coding jobs and engineering jobs because of AI. I think that's very clear. But outside of those big tech companies that are actually developing these technologies, I think it's kind of a stretch to say we're losing a lot of jobs in other non-kind of technology industries yet because of AI. It may be true, but I don't think we can really know that at this point. I think it's a very fuzzy area right now. Like Meta, right? Like Meta is the perfect example. They are restructuring their whole AI research, right? That's why all these thousands and thousands of layoffs. They're laying off a lot of people, but they're hiring a whole bunch of other people and they're restructuring. But they do AI. That's what they do. I'm not seeing a ton of companies outside of tech that are saying we're laying off 10,000 people because AI can do the job of a new bachelor's degree hire. That I haven't seen en masse yet. So I'm a lot more worried about the financial system impact of these AI companies and what's going on with their valuations and
the equity market
and all of that than I am about the job market right now. I'm much more worried about a financial market bubble led by AI than I am about the job market over the next year imploding because AI is going to take everybody's jobs. I think that's a long way off.
Well, that's a topic for a whole nother discussion. What's going on in the equity market. Chris Lafakis, I've kind of cut you out. We are definitely coming back. We're going to play the game and then come back and talk about climate and storms. But very curious. You've been listening to this discussion. Anything you want to weigh in on with regard to the conversation?
Yes. I worry about cracks emerging in the labor market that will take years to repair, particularly the labor market becoming less dynamic. I think it's been mentioned on this podcast, we've lost 2 million workers, foreign born, over the past year. We have baby boomers retiring. We have layoff announcements, Challenge a Great Christmas, that some of them are affecting white collar industries. And that's a big hit to labor supply. Another thing is the decline in enrollment at American universities of foreign-born students. And that's a loss of dynamism for the labor market. And I do worry that it's going to be hard for employers to find qualified candidates to fill their open positions. And maybe that makes them more likely to replace labor with capital. And, you'll have maybe people in white collar industries that are going to have to work in working class industries because that's where the jobs are and they can't find jobs in their desired field. So by the numbers, if you look at the unemployment rate, it's not going to provide any insight on this dynamic. But I do worry about the labor market being less dynamic on the whole.
I want to move on, but I guess the other way, going back to my kind of emotional problem with all this is, historically, for most of my career, understanding the economy meant understanding demand and what's going on the demand side of the economy. On the supply side of the economy, it moves, but moves very slowly. Get your mind around. There's times when that's not true, like around the Y2K bubble, same kind of dynamic as we're experiencing here. But right now, since the pandemic, the supply side is moving even more than the demand side. And, actually, in a real sense, economics is really simple. It's demand and it's supply. That's what it's about. The hard part is figuring out what's going on with demand and supply. When they're both moving around, very difficult to get a sense of what's going on. And by the way, it's moving differently in different industries, different occupations, different regions of the country. So it's making it very, very difficult to get your mind around what exactly is going on. And then you have no data. You throw no data into it, and I feel emotionally I was going to say unhinged, but that sounds. I don't want to. I'm okay, everybody. I'm okay.
Okay.
Mark's okay. Don't write to us.
Yeah, don't write to us. I'm okay, but I just feel at loose ends. I feel unmoored, by it all. Anyway, before we go to play the game, very quickly, Chris, we had the Fed meet again this week, and they cut rates as expected, quarter point. The funds rate target's now 3.75% to 4%. A lot of moving parts there, a lot of interesting stuff. What's your takeaway from the Fed meeting? I mean, obviously, collectively, the FOMC is focused on the job market as well, like we are, and saying, hey, we're not comfortable with, the kind of what we're seeing there. Therefore, we need to cut interest rates and get the interest rate back down to something closer to equilibrium here pretty quickly. But any takeaways from the Fed meeting?
Yeah, definitely a hawkish cut, right? They cut 25 basis points, but then immediately afterwards said, well, don't count on this for December, right? Telling the market essentially that should not be a foregone conclusion that they're gonna cut again in December, given the issues with inflation and other parts here. And I think also just given the lack of data, they want to leave their options open as they try to figure out what to do here. So yeah, I think that was certainly a message that rattled the market a little bit, right? You saw some movements in the
if you call that a rattle,
well, a little bit, yeah.
I mean, we saw one little negative sign, on the Dow Jones, I guess.
Well, I was thinking the 10-year bond rallied.
The 10-year bond,
the yields increased.
Yeah, there you go.
I guess, but who knows? 8 basis points a movement anymore?
Yeah,
that's
exactly.
Nothing. Yeah. There was some reaction. Let's put it that way. The odds of a rate cut in December fell to 75%. They were at 90%, but they were at 75% a month ago. So it's not as though we're dramatically rewriting history here, but just letting investors and businesses know that Fed is going to continue to look at this one step at a time. Inflation remains sticky, right? And so they very well may not cut in December. So get ready, buckle in.
Yeah, I thought it was interesting that you had two dissents this go around. One
in opposite directions.
Even Murren, who said, I want to cut rates 50 basis points, not a quarter point. He's the former head of the Council of Economic Advisors under Trump, so he's all on board with cutting more aggressively. And then you have I think it's the Kansas City Fed president who said, no, I think we should raise rates a quarter point.
No, I think he said no action.
Hold.
Did you say no action? He didn't
Yeah.
say raise? He said no action? Okay. All right. Okay. But it feels like we're now getting a two-sided debate here. And to your point, I guess, Chris, this is a so-called hawkish cut. They cut, but they're kind of signaling that maybe we're not going to cut. We might cut in December, but we're not going to cut as aggressively as you might. We don't know. We'll have to see how this plays out. It's not a done deal that we're going to be cutting aggressively.
It's not a done deal. That's the message, right?
Yeah.
Don't get complacent.
Don't get complacent. Yeah. Which is a reasonable thing in the context of the labor market is weak, no doubt about it. Therefore, all else equal, you would say, okay, I got to cut. And, if they're listening to my angst, they say, okay, I got to cut reasonably aggressively. But then on the other side of this, inflation is well above target. I think inflation now is 3% based on the CPI, and the target is a little over 2 based on the CPI. And the direction of travel here is not encouraging. It's going to continue to accelerate. And then financial conditions, going back to the equity market, right? I mean, the equity market the stock market's on a tear, and you got mortgage rates back down. What are they, Chris? They're at 6 now, 6% on a 30-year fix, something like that.
No, they bounced back, right? Because the 10-year moved up.
Was it back over 6 now? Okay.
It was 6. No, it was 6. It got down to 6.2.
6.2
on 30, and I think it's now back up to 6.3 something.
Okay.
Yeah,
and then you've got 6.3, and then you got credit spreads in the bond market, which are thin, and got crypto taken off. I guess gold's come back up. But I guess my point is financial conditions feel like they're pretty easy. And that would argue for a rate, certainly not a rate cut, a rate increase. So you can see why there's a reasonable debate here. Anyway.
They share your angst.
They share my angst. Yeah. Let's play the game, the stats game. We each put forward a stat. The rest of the group tries to figure that out with clues, questions, deductive reasoning. The best stat's one that's not so easy, we get it right away. One that's not so hard, we never get it. And if it's apropos to the topic at hand, Zandi's angst, then, all the better. Maybe that's the title for this podcast.
I think it is.
Yeah, there it is. Nailed that. We always begin with Marisa, or at least most of the time we begin with Marisa. So let's do that. Marisa, you're up.
All right.
If she's here, we start with her. Right.
Yeah.
Well, there was one time we didn't because we
were
deferring to the guest.
Oh.
Yeah.
Who was?
Maybe you weren't here, Chris, actually.
I missed that.
Yeah.
I don't remember who it was, but yeah, I'll happily go first.
Go first.
$6.6 trillion.
$6.6 trillion. That's not this stock market valuation for NVIDIA.
Oh, it might be, but that's not what I'm thinking of.
NVIDIA is like $5 trillion, I think, at this point. But it's not stock market valuation.
It's not.
No. It's
No.
not. By the way, I was going to use this as my stat. I blew it, so I better tell you now. $10 trillion. That's the increase in the value of all publicly traded stocks over the past year, according to the Wilshire 5000. It's gone from 58 trillion to 68 trillion. To your angst,
yeah,
about the market. Okay, so back to 6.6 trillion.
Natural disaster related?
It's not. No.
Wow. That's a tough.
Is it U.S. or global?
Budget, the fiscal situation. I can't think.
It's not the federal budget. What did you say, Chris Lafakis?
I was going to ask if it was relating to the U.S. or is it global statistic?
Yeah, it's U.S.
U.S. Not the fiscal situation. 6.6. Anything to do with AI? Oh.
How about interest on federal debt?
No, not fiscal situation. Give us a hint, Marisa, if you can.
We were just talking about this topic before we did the stats game.
Fed. Is this something to do with their balance sheet?
It is their balance sheet.
As
of yesterday.
Yes. The end of QT.
That's right.
The end of QT.
Yeah. So
that's
good stat.
Yeah.
Good stat.
The thing we didn't talk about, so we talked about the fact that they cut the Fed funds rate by a quarter point. But the other thing they announced is that starting on December 1st, they're going to start reinvesting in treasury securities that are much. They're gonna roll over MBS into treasuries, and they're gonna roll over treasuries back into. They're gonna start reinvesting that instead of letting it run off their balance sheet. So they've drawn down their balance sheet by a couple $1 trillion over the past couple years. They've been engaging in QT, and they are going to stop doing that as of December 1st. They see potential liquidity issues in money markets and short-term lending vehicles. So not only are we cutting rates, but we're also going to end QT here.
That's interesting. That's good. That was a really good one. I did hear, Chris Lafakis, that the GSEs, Fannie Mae and Freddie Mac, are actually now buying their mortgage securities. Have you heard this? And so the Fed ends its QT, the FHFA and GSEs begin QE. You know, they're quantitative. They're buying their MBS. Have you seen that? Have you heard that?
I had heard that was being floated as an idea, but I didn't realize it was active now.
I think that I'm hearing it on the, from market participants, people that are actually in the market, that they're observing some buying here. No one's announced it at FHFA or at the GSEs, as far as I know. But I found that pretty interesting. That, obviously, if they're buying mortgage securities, they're trying to get mortgage rates down. That's the idea here. Sorry,
I guess they
Chris.
still have the portfolio caps in place from the. Remember, they used to have large portfolios of investment, and they were capped as a result of the Great Recession. Yeah. I'm assuming, but they may be below those caps still. Who knows what happens next? But interesting.
Or even they're following those caps. I mean,
Yeah. Who knows?
Maybe. Yeah. Who knows? Okay, that was a good one. Okay, Chris Lafakis, you want to go next?
My stat is 30.
30. Is that anything to do with climate change?
No.
30 days of government shutdown.
Yes.
Oh.
That's what it is. Good one. Good one.
Either I made my stat too easy or Chris is brilliant, or both.
I think that was his stat.
He
was thinking that was going to be his stat, I think.
No.
Yeah. This is now the second longest government shutdown on record. The longest was 35 days. I think it's highly likely that this will become the longest government shutdown ever. President Trump is in Asia. He is not negotiating. Democrats, I think from their vantage point, they're running out the clock on a Republican-controlled Congress because no new pieces of legislation are being passed while we're at this impasse. And there doesn't appear to be a forcing mechanism. I mean, healthcare premiums are going to go up in the not too distant future, but it's not clear that that's going to bring anyone to the table either. And because we're in a highly polarized political environment in the U.S., there's less incentive for either party to compromise. So I'm worried that this shutdown is going to drag on for quite a while longer.
Well, that's a good one. I recorded a webinar with two of our other colleagues, Brendan Lacerda and Justin Begley, who have run a couple scenarios around what would happen to the economy if the shutdown lasted for a long time, through the end of the quarter. So highly recommend that. But that's a great one, Chris. Yeah, and if you're absolutely right, it doesn't feel like this is going to take a while to resolve. So 30 days can come back on in a couple of weeks. We may still be talking about government shutdown. Okay, one more. Chris Lafakis, you want to go?
Sure. $5.03.
$5.03. That's not copper prices, is it?
It is, Dr. Copper.
God.
Yes. Well done. Well done.
There you go. Wow. But that's a big statistic. $5. Has it ever been at $5?
Yeah, it was higher than that earlier this year.
Was it?
Not much higher, but it was actually just before yesterday. Yesterday, I guess it was 18 cents higher, or 3.5% higher. So we came in quite a bit today in relative terms. But I wanted to ask you, it's elevated, even if it's coming down. $5 would be high by historical standards. So what does that tell you, Mark? I think this is your original statistic from the very first episode of Inside Economics, if I recall.
Right? Yeah, 4+ years ago now, 4.5 years ago now, right?
Yeah.
Yeah. I think it's lost its luster, my friend. It's gotten caught up in the commodity price boom, gold prices, silver prices, copper prices. A lot going on in the commodity complex, and I think it's kind of independent of kind of broader global forces. I think there's still information there. I mean, I think if it were $4 headed into the threes, that might suggest that demand is off and the global economy is starting to suck some wind. But right now, I think there's so many other dynamics here that I'm not sure what to read into $5. Would you agree with that?
I would. And I think we also have talked in the past about the energy transition, electrification, and EV, right? So the demand for copper is up. So maybe it used to be $4, right? Was the
threshold.
Was the threshold or the tipping point. Maybe it's closer to $4.50 or $5 now, given those structural demand changes.
Right. Well, that was a good one. Well, we're running a little late here, and I've got the public finance folks out here, so got about 15 minutes left. So let's turn to your study, Chris Lafakis, and the work you've done. And maybe before you go there, maybe you can just give us an update on the hurricane, the Category 5 hurricane that hit Jamaica. Anything to report there? What's going on, and then let's turn to the work that you've done. And I should say, you have produced a white paper study along with our colleagues over in the insurance unit at Moody's, who obviously are very involved in these kinds of issues, on simulating the climatological and the macroeconomic consequences of a Category 5 hurricane hitting South Florida, hitting Miami specifically. And it was a great study. We'll put the study in the show notes. And there's also a webinar that we'll give people a link to so they could go look at that. But maybe, Chris Lafakis, you can kind of give us a synopsis of what's going on in Jamaica and then pivot quickly to your study.
Absolutely. I'd be happy to do that. So Hurricane Melissa made landfall in Jamaica on October 28th at wind speeds of 185 miles per hour. That makes it the third strongest hurricane ever recorded in the Atlantic hurricane history. The only two that were larger were Hurricane Dorian in 2019 and the so-called Labor Day hurricane of 1935. And it led to storm surge. There were destructive winds, heavy rainfall, led to widespread property damage, mandatory evacuations, power outages, infrastructure damages, and of course, unfortunately, some lives were lost as well. I think the estimates are that there's about 70% of Jamaica that is out of power, and internet outages are around the same percentage as well. It's going to take, I guess, it's still playing out. So the hurricane also hit Haiti, Cuba, Dominican Republic, was on a path to Bahamas. Turks and Caicos, Cuba will also feel the effects of this hurricane, but the primary macroeconomic loss would occur in Jamaica. I do expect this to have a macroeconomic impact, aka GDP, that will primarily be felt from the disruptions to power, communications, internet, disruptions to tourism activity. Tourism is a major export for Jamaica, a service export. Hits to agriculture with crop fields being destroyed. Jamaica specializes in things like cocoa and coffee and sugar and bananas. And then also the hit to infrastructure as well. So for those reasons, I would expect a temporary but severe decline in GDP. I think from an insurance perspective, I would say that Jamaica is particularly interesting because according to the Insurance Association of Jamaica, only about 20% of residential properties in the country are insured, and an estimated 95% of those already insured are underinsured. So I think that there will be quite a big hit because of the lack of insurance and underinsurance in Jamaica, particularly in the residential sector. In terms of commercial, you've got 7 large hotel resorts that experienced wind speeds of over 90 miles per hour. That's just below hurricane level wind speeds. And one of those resorts, the Sandals South Coast, experienced particularly high wind speeds of 150 miles per hour. So, and those properties are insured. I wouldn't expect a disruption to the insurance sector of Jamaica as well, because they have reinsurance. I think that most of the consequences will be felt, number one, in terms of the GDP impact, and then number two, for the residential sector, these underinsured and uninsured properties.
Okay. And as you said, it's still playing out here. It's hitting Haiti at this point. It's going to miss the U.S. though at this point. Is that correct?
Yes.
Yeah. Okay.
That's right.
We've been kind of lucky here, right? This hurricane season. I mean, it's not over. Knock on wood. So I think the hurricane season goes into November, but at least so far, we haven't really been hit by any major storms. Is that? I got that right, Chris?
Yes. It's not like last year when we had the Hurricane Milton,
right.
storm hitting the Florida, the middle part of Florida. We've been largely lucky, but fingers crossed.
Yeah, and that's your study, the study that you just recently published with the folks over in the insurance group. Give us a sense of what you did there, and give us some sense of the findings.
Yeah, so it was a really great collaboration that we did, as you mentioned, with the folks in our insurance OU. And you might know them as formerly RMS, big players in the natural catastrophe and insurance space. Their forte is to produce kind of a stochastic set of natural disasters or perils, that there can be various perils. It could be North Atlantic hurricane, it can be European windstorm, it can be typhoon, and so on and so forth. So there's a model for each peril in each region, and there's a set of storms that are constructed by Moody's Insurance, based on A, the history of storms that have occurred, and B, the potential set of storms that didn't occur but could have occurred. So the idea is to get a representative sample of all of the different storms that could hit in a given region of a given type, and what their probabilities are. So from that stochastic set of storms, we picked out one which made landfall in Homestead, Florida, which is in Miami-Dade County, that has a severity on par with that of Hurricane Katrina from an economic loss perspective. And the probability of this storm occurring is 1 in 40, so about 2.5% in any given year. And we wanted to use kind of that catastrophe modeling as the backbone for generating economic scenarios. So comparing the output from those natural catastrophe models in terms of property loss, insurance characteristics, loss type, to other storms that we've experienced, to get a sense of what would happen to GDP in the Tri-County area of Palm Beach County, Broward County, and Miami-Dade, what would happen to population, and the unemployment rate, the GDP, et cetera. And then based on that, we had to analyze the characteristics of the Florida insurance industry, and also make some assumptions around federal aid and the state response as well. So we constructed 2 scenarios. One is a moderate scenario and one is a severe scenario. And the moderate scenario assumes that there will be a federal aid response on par with what we have experienced historically since the 1980s and Hurricane Hugo. And that's about, 50%-ish of the total amount of economic loss would be provided in federal aid as a form of supplemental appropriation. So that'd be a bill that's passed by Congress and signed by the president. And we also expected, as part of that scenario, a state response to backstop the private insurance industry. And in our severe scenario, we didn't assume as much support for the state private insurance industry. And we also did not assume that there would be supplemental appropriations passed. So so we constructed these two scenarios with these two assumptions. We also considered the impact on house prices, and there were three channels through which house prices were affected in the study. The first is through the endogenous impacts of the storm on demand. So principally a reduction in propensity to earn, and that's because of power outages and loss, relocation from the area, albeit on a temporary or permanent basis. That impacts ability to buy, impacts housing demand. So that was solved endogenously by the model. The second channel that we considered was the impact of uninsured losses on the value of the housing stock. So this would be for properties that are not insured. If you're insured, it's fine because capital comes in to replace the damages that were suffered. But if you're uninsured, then capital doesn't come in, and if aid isn't being provided, then that's a big problem. And if you're kind of a home that is damaged, we had to make assumptions on whether or not homes would be damaged or destroyed, because technically, if your home is destroyed, then it falls out of the housing stock. But if your home is damaged but it's not destroyed, then it's still in the housing stock, but it's worth less. So that was the second channel that we considered for the impact on house prices. And the third channel is a channel of increased insurance costs. And this is almost taken for granted in most modern econometric house price models. But if insurance costs are escalating at an abnormally high rate, then that increases the cost of operating and maintaining a home. And insurance is one part of that cost. Property taxes are another, maintenance costs are another, mortgage payments are another, and so on and so forth. And so we decomposed the cost of operating and maintaining a home into these various parts, assumed an increase in insurance premiums. There's two different insurance premium trajectories based on the moderate or severe scenario, and then calculated the hit to HPI from that third channel. And we put them all together to get a holistic house price forecast for both the moderate and the severe scenario. So our study produced a full range of macroeconomic indicators consistent with what our subnational models produce. That's estimates for the labor market, for population, for GDP, for house prices, and so on and so forth, across both of the scenarios. And what we found is that a scenario of either type occurring, the moderate or the severe scenario, would be worse than a severe recession scenario. You can think of it as the S4 scenario in our standard alternative scenario parlance, which is a 4% likelihood of occurring. So either of these scenarios occurring would be worse than that severe recession scenario. The temporary hit to GDP would be as high as 30% in either of these scenarios. Of course, that would recover over time, but there would be a long-term shift down in the level of economic activity because of population outflows.
Hey, Chris, there's a lot there. And you're talking to a group of listeners that, don't know S4, don't know OU, don't know, some of the things that you're talking about here. But the things that struck me from your work is you said that there's a 2.5% probability that a storm of this magnitude, a Category 5, is going to slam into South Florida in any given year. Is that right?
Yes.
And that's based on the work that the insurance folks have done, our insurance colleagues have done. That's their assessment of the probability of that happening.
That's correct. Yes.
Okay.
It'd be a 40-year return period.
I don't know. It sounds low, and then it feels really high. That seems scary. What can I ask?
Well, then it must be the right number.
Yeah. Well, what does it mean? What was the probability that you get a Category 5 that hits anywhere in the continental U.S.? Do you have that number? It's got to be higher than 2.5, right?
Yes, I would think that it would be higher than 2.5.
Any sense of what that number? I'm just asking. I mean, there's probably too much to ask, but I'm just very curious. Is it 5%? Is it 10% in any given year?
If you asked me to put a number on it, I'd probably put 5%.
5%. Okay. Of course, South Florida is highly exposed, so that might explain it. But Okay, so in the scenario where this Category 5 slams into Miami, isn't it, you talk about all the kind of macroeconomic, all the economic consequences, the impact on house prices, and uh, isn't that a scenario where the actual insurance industry in the state is at real risk of of imploding because of the costs that are involved with that?
So I think in the severe scenario, I would answer yes. There's three entities that you want to keep track of when it comes to a scenario like this playing out in Florida. The first is Citizens Insurance Group. This is the kind of so-called insurer of last resort. It is a publicly financed insurer. Um, it has reinsurance to cover its obligations. So it would take pretty much a 1 in 100 year storm to cause Citizens to have to do assessments, basically, to assess every homeowner in the state to come up to fill its capital shortfall. So in both scenarios, we don't assume that Citizens has to do that. The second is the Florida Hurricane Catastrophe Relief Fund, which is more exposed than Citizens. And we assume that there is an assessment by FHCF, Florida Hurricane Catastrophe Relief Fund, in this scenario that is roughly 2% of premiums on all property and casualty policies in the state of Florida. Florida's laws are written such that it doesn't matter that the storm happens in Miami. If FHCF has to issue an assessment, then all P&C policies in the state are assessed. So we do assume that takes effect, and we had to subtract that from real disposable income when we were doing our economic scenario. And then the third entity is private insurers. And if you just kind of took the approach of let them eat cake, then there could be some insolvencies among smaller insurers. But we assume in the moderate scenario that there is state support for the private insurance industry. There's a couple programs like RAP and 4. I'm sorry that I don't know I can't come up with what they stand for.
No, that's
off the
okay.
top
No
of my
worries
head,
about it. Yeah, we get the drift. Yeah, for sure.
Yeah, but those would be put in place to protect the private insurance industry in the moderate scenario.
Okay. So you're saying what I just heard you, I think I heard you say is the insurance industry in the state would be a significant threat and would require some form of state government support to kind of make its way through, given the losses. That's what you're saying.
That's what I'm saying. And in the severe scenario, that doesn't happen to a great extent, and hence the trajectory for premiums. Now, both of them have substantial premium housing insurance premium increases, but there is a more moderate increase in the moderate scenario that is because of state support for the private insurance industry.
Okay, so take a step back. Stop talking about scenarios. I mean, the reality of what's going on here. It feels like this is a real serious threat. I mean, we got lucky this year. No hurricanes that kind of hit of any consequence, but that's not the numbers. The numbers suggest we're going to get hit at some point, and the consequences of that are certainly for Florida a big deal. It feels like that's the bottom line here.
That's the bottom line. I mean, and in a time when we're less certain what the federal response will be, there's been talk of dissolving FEMA, and would we pass a supplemental appropriations bill if a hurricane of this magnitude were to hit Florida? Is that the direction that the Congress is going in at this point? So I think it's a very interesting time when we have global temperatures that are higher than they've ever been, and yet we're thinking about kind of dialing back assistance. And how would this play out? Because policy is incredibly important in determining the macroeconomic fortunes of these local economies, the state policy response and the federal policy response. And our work highlights that.
Okay. I mean, and I guess the other point is that while all of this is a forecast and this is in the future is now, and it's having an actual economic consequence because it is affecting insurance rates and the availability of insurance, which is affecting house prices and commercial real estate values and just overall kind of broader economic conditions. Is that fair?
Yes, absolutely. And I think we see that if you look at California with the Palisades wildfires and the stress that the insurance industry in California is under. And even before the Palisades wildfires, you had companies like State Farm that were pulling out and, non-renewing certain policies. And so insurers are taking a long and hard look at whether or not they want to be active in certain markets. And then if to the extent that they are not, or they're withdrawing, then that forces states to kind of step in and create, insurers of last resort. And that's Citizens for the resi market and commercial market in Florida. And that's the FAIR Plan for fire insurance in California. So I think that we're kind of in uncharted territory in terms of insurers responding to the increased risk that is occurring, that they are facing. They have to make decisions on what policies to underwrite and what the state responses are to those policies.
Hey, Marisa, anything you want to ask Chris before we call it a podcast? We're getting close to the end here, but I just want to give you and Chris a chance to pepper Chris a little bit if there's anything that you want to bring up.
Yeah, sure. I'll go back to kind of the current hurricane to Melissa. Are there any damage estimates out there yet, Chris Lafakis, in terms of loss of GDP? I mean, I know Jamaica is a pretty poor country, right? And your stats about the low rates of insurance coverage are pretty alarming. So what does this mean for the economy of Jamaica and some of these other Caribbean nations that have been hit?
Well, I think that in terms of the estimates of loss, it's going to take weeks or months to determine estimates of both economic loss and insured loss. I would expect that economic loss will be multiples of insured loss just because of the comparatively low levels of insurance coverage for Jamaica and other countries in the Caribbean. And I think that the loss is going to hit disproportionately on kind of the less insured or, less capable portions of Jamaica's economy. So, we worry about, farmers that don't have insurance, or homeowners that don't have insurance, or if they do have insurance, it's incredibly underinsured. So I do think that there will be a GDP hit, like a noticeable GDP hit. And this wasn't the case with Katrina, where you had a U.S. economy that was so large that it didn't really feel the effects of New Orleans. But I think that when we're talking about Jamaica, we're definitely going to feel the hit to ag, the hit to tourism, because tourism is extremely important to Jamaica. All the hit to infrastructure as well. So I don't want to put like a number on it, but I think it's going to be noticeable when the GDP data actually come out.
Yeah. Okay.
Yeah, I'll ask a question. Now, I understand that Jamaica has a $150 million catastrophic bond that is going to pay out, given the intensity and the parameters of this hurricane. That seems to be the case. All right, so that's immediate capital that can help to rebuild or restore some of the losses here. I'm wondering if you're seeing these catastrophic bonds as a potential solution to some of the insurance shortfalls that you mentioned. Are states like Florida or other municipalities using them, or what's your sense of this market, and is this a solution that's going to continue to grow?
Yes, absolutely. That's a really good question. So there's pre-event and post-event cat bonds. And for the Florida study, we did assume that the pre-event, the post-event cat bonds would be issued. And that's necessary to replenish capital that these organizations would have depleted as a result of the natural disasters occurring. So it's like these organizations, it's Citizens or FHCF or the country of Jamaica have to come into a hurricane season and determine, okay, this is how much we've insured, this is how much reinsurance we're going to purchase. This is what our plan would be if a storm of X magnitude that exceeds our reinsurance occurs, and we would have to issue cat bonds to kind of replenish our reserves and either backstop private insurance or private insurers or pay out on policies. And so these entities within states, U.S. states or countries in the Caribbean, they have to make a determination as to what their risk tolerance is, and how much reinsurance they should purchase, and how many policies they should underwrite, and at what cost those policies should be underwritten. And the cat bonds are a great tool. You can use pre-event or post-event in order to generate the revenue streams that would be necessary to either shore up your capital base ahead of a hurricane season, or to replenish capital on your balance sheet that was depleted by the storm. So I think increasingly they are going to be used as part of an overall kind of risk management strategy by both state entities and Caribbean governments.
Well, Chris Lafakis, thanks so much. I mean, you did really great work, and you built up this expertise over a long period of time, and you're really very knowledgeable on this topic, and really key to all the work that we do in this area, and trying to understand what it means for the economy, and both at the national level, but also at the regional level. So thank you. And with that, we're gonna. I always think that this is gonna be a 40-minute podcast, but it always is an hour and 10 minutes somehow, some way, some kind of law of podcast physics. I'm not sure, but here we are. But it was a good conversation. I really appreciate it. And guys, I think we're going to call this a podcast. Dear listener, we'll talk to you next week. Take care now.